I'm Michael Smith.
I'm Chuck Osborne,
And welcome to the Iron Capital Podcast,
where we break down investment stuff with anecdotes and stories that non-financial geeks can understand.
Hey, this is Michael.
And this is Chuck.
This is the inaugural episode of the Iron Capital Podcast. It's a big year for Iron Capital. This is our 20th year anniversary.
Wow.
So we're awfully excited about that.
It is exciting.
Yeah, so it's Tuesday, March 28th, and let's get to it. Chuck, what's on your mind?
Myths, Michael. Myths are on my mind, and specifically busting myths. Yeah. So we're going to do some myth busting.
Let's get into it.
Do you remember that show used to be on TV? They used to blow stuff up.
Yes. You know what? I need to let my son, he's 8, Griffin, he loves to see things blown up.
Yeah.
So I need to let him see that show.
Well, we're not going to literally blow anything up, but we're going to kind of figuratively blow some investing myths up today. All
right. Well, let's talk about the first one.
All right. Well, the big myth that we have is that, and this has been in the investment industry for as long as I have, which is at least 30 years and probably goes back farther, is that the closer you get to retirement, the more conservative you have to be in terms of moving money from stocks into bonds. And, there are multiple problems with that, but one of the biggest problems is that it ignores the biggest issue that most people have in retirement, and really is the biggest risk in retirement, and that is outliving your money. Mm-hmm. And it focuses too much on the risk of there being a bear market at or close to your retirement. So we thought it was a good time, because we're in a bear market, to talk about, can you retire in a bear market, or what does a bear market do to you as you're approaching retirement if you're within 5 years of your retirement age?
Or 2 years.
Or 2 years.
Which we have plenty of clients that are getting close.
Yes.
So and that is, we should have said that in the beginning, this, the theme of this is retiring in a bear market, and then how to turn your nest egg into retirement income, which we'll obviously get into that. I do still think we need to talk about what is a bear market, so everybody's on the same page. A lot of people are talking about it. What is it? Before we get into that myth, let's talk about what a bear market is.
What is a bear market? Well, technically, if you look up the textbook definition, it's going to say it's when the market goes down by 20%. Mm-hmm. But really, it's kind of like that old. The politician was asked, if he could define pornography. He said, I might not be able to define it, but I know it when I see it. And, with a bear market, you may not be able to define it, but you can certainly know it when you feel it. And that's really, you feel it more than you see it. You just get a period of time where the market is going down instead of up. Yeah. And most of the time, the market does go up. If you go back into history all the way back to 1926, the S&P 500, 72% of the time the market goes up. But there is a quarter of the time where the market does actually go down, and we refer to that as a bear market.
Yeah, and you get short bouts of down markets called corrections, which is, you normally think of that as 10%. But again, it's a feeling thing, right? Like, a correction doesn't feel the same because it happens relatively quickly often.
Well, right. And just like in a bull market, which is a market that's going up, you will get the 10% corrections. Nothing in the real world goes in a straight line. So you don't just go straight up. You go, you take 3 steps forward and 1 step back, and that's how the bull market works. Similarly, the bear market works the same way. It doesn't just go down in a straight line. You can have big rallies in the midst of a bear market, where the market may jump up 5-10% and do it very rapidly. Yeah. But that doesn't necessarily mean the bear market is over.
Yeah. In the average bear market, 280, 290 days. You have bear markets that have gone 500 days. So they can be a very varying length, but again, it tends to be a little longer than this short little blip down, like a correction.
Right. And it just depends. We had a bear market at the beginning of the COVID outbreak. And that was very short-lived.
That was extremely short-lived.
And the market bounced back rapidly. If you go back to the dot-com bubble bursting in 2000, and there was a confluence of events there, which is often the case, but you had the tech bubble bursting, and then you had 9/11, and then you had Enron and all these corporate scandals that occurred, and that was a bear market that lasted seemingly almost 3 years.
Yeah.
So, yeah. I mean, it's there's no strict rules, but generally speaking, we're talking about a market where the long-term trend has actually turned downward. And I guess we need to define long-term, because a lot of our clients will come to us when we talk about things being long-term. We're talking about like a 200-day moving average when we're talking about long-term, which really isn't all that long-term.
Yeah.
But when you live and breathe this stuff every day, 200 days seems like a long time.
It's like an eternity.
It does.
Yeah. Well, I don't want to beat the dead horse of a bear market, but one thing to keep in mind too, and this is actually important with the conversation, is they're normal and they happen relatively frequently in the big scheme of things, right? So
yeah. So if you think just from the sheer odds, now if you go back in history, the bear market tends to follow the business cycle, and the business cycle tends to run in 5-year increments. But if you just look at the statistics I just quoted, the S&P 500 is up 72% of the time. That means once every 4 years, on average, the market would be down. So yes, every 4 or 5 years you're going to have a down market, and that's completely natural, and it's healthy. It's one of the things, and this is probably a topic for a different day, but one of the things you really wonder from a policy standpoint, we're so set on trying to stop these things from happening that you wonder if we're making it worse instead of just allowing nature to take its course, and realizing that just like winter follows fall, and then spring, and then summer, and then we have fall again and winter, that the business cycle has seasons as well, and we just need to let them happen.
Yeah, well, and it in some ways investors are so it's interesting, right? It used to be every 5 years you saw one of these. Now it's pushed on. The last few, it's been closer to 8, 10 years, right? And so investors in some ways are spoiled because they're not used to seeing it, but it also scares them more because they're not used to seeing it, and it doesn't feel as normal.
Right. So you're absolutely correct. So in the going back to the 80s and 90s, prior to that, the idea was, from an economic policy standpoint, was mostly driven by Keynesian economics. And Keynes's theory was that the government could soften the business cycle, and therefore the market cycle, by using fiscal stimulus. So the government could spend money, tax less, and either soften a recession or prevent a recession from happening. That did not work too well. And so Milton Friedman came along, and his idea was that no, it's not fiscal policy that can do that, it's monetary policy that can do that. So the Federal Reserve can, by lowering interest rates, making it easier to borrow money, they can soften the impact of a recession, or even prevent one from occurring. And that has worked in the sense that it's prolonged the business cycle. And so really starting in the 80s, we had the longest period of growth in history. Then in the 90s, we broke that record, and then and that led to the dot-com bubble, which was a 3-year bear market.
Yep.
And then we had another long period of time of expansion, and which led to the financial crisis, which is, again, not just a run-of-the-mill recession, but the biggest recession we'd had since the Great Depression. Mm-hmm. And so, yes, we're prolonging the cycle, but are we actually making the recessions worse by doing that? And I think at some point they have to take a look. Is this really worth it? I mean, would it be better to just have a run-of-the-mill recession every 5 years instead of having a giant crisis
every 10 years?
Every 10 years.
Yeah.
And I don't think that answer is obvious. Let's just put it that way.
Yeah. Well, let's go back to the myths question then, right?
Sure.
Let's bring it back a little bit. So there's multiple myths. I don't know if we want to go into the other ones or just you want to mostly talk about that one.
Well, I do, because I think, we're celebrating our 20th year. I've been in this business for 30 years, and almost all of that time has been helping people towards retirement. That is, I've always been investing money, but the vast majority of the money that I have run in my career has been geared towards retirement. And I've seen a lot of retirement mistakes, and they're driven by these myths. So the first myth is that, well, if you're young, you have time. So that's the big things, like you can withstand the bear market because you've got lots of time before you retire, and you should just take a lot of risk. Well, that's theoretically true, but there are a lot of young people who aren't that risk tolerant. Yeah. And so, if you're actually risk averse, even if you're young, and you end up taking more risk than you really are comfortable with, because everyone keeps telling you you're young, you need to do this, then you run the mistake of you take too much risk. Eventually there is a bear market. You see the value of your investments go down. You panic, and you end up selling right at the wrong time.
Yeah.
So you sell right at the bottom of the bear market. It's always that final capitulation that we all look for as market participants, that signal the end of the bear market, and that is usually when those people just can't take the pain anymore. And so now you've taken what was just market volatility and you've made it a real loss. I mean, you have now recognized that loss. It's real, and then it's compounded because, once burnt, twice shy.
No, it's psychology. It's like all investing. It's all psychology, and so much of it is, right?
Oh, absolutely.
You've scarred psychologically, and then you cannot take advantage of what you should have been able to take advantage of over your life.
So that is the typical mistake of someone who's in the accumulation phase, and we talk about that all the time, and rightfully so. But that is the one we talk about all the time. The second mistake that we see is, and this is kind of a myth, in that all you need for retirement is a financial plan, and really that's not the case. And as we talk about, we do financial plans for our clients. We don't like that terminology. We refer to it as projections, because that's really what it is. You're projecting a future. And it's a useful exercise, but you don't. I think a lot of people sell it as being a lot more definitive than it is. But what you really need is an action plan, and we see this all the time. We see people. You laugh about. You mentioned our clients who are going to retire in just a few years. We had one client who finally has retired. But for almost a decade, he kept telling me he was going to retire in 3 years. And every year we met with him, he's like, another 3 years. And I was like, well, that's what you said last year. And he said, no, another 3 years. And the reality there is, here's a guy, he's a successful executive. He's been busy all his life. He's got a lot of purpose in his life. And what's he actually going to do?
Yeah.
And that's one of the things that people don't think enough about, because retirement is kind of marketed as if it's just a great big vacation. It's not a vacation. It's a stage of life. And just like all your stages of life, you have to have a reason for getting up in the morning. You have to have something that's going to occupy your time.
You've got to be productive.
And
we
your brain.
As humans need to be productive. Now, it doesn't have to be productive in the same way, but you have to do something.
Right, you have to do something. Right, you have to do something, whatever it is, and so that's the other big mistake that we see people make, is that they retire without a plan, and then they'll call us 6 months later and say, well, I'm going back to work. And so that's one of the mistakes. The other mistakes are they don't take care of themselves. And our medical complex industry, whatever you want to call it today, it is really good at keeping people alive. it's not good at keeping people healthy.
Yeah.
And the
health span versus lifespan, right?
No, amen. I mean, and unfortunately, we have seen this with our clients, and we're fortunate enough to have had several clients that have lived into their 90s.
We had one that lived, 105?
105, yeah, yeah. But yeah, when you have, one has to take care of themselves. And even if you've never exercised a day in your life, when you retire, you better start doing something. And then, we're not talking about running Ironmans or anything, but you're just getting out for a walk.
Walking,
Keep your body moving, because especially as you age, if you don't move it, you're going to lose it, and you do not want to outlive your health. Unfortunately, we've seen it too many times. You don't want to be in that situation where you're outliving your health. Mm-hmm. And which leads to the big myth I think we have today is the fourth mistake. And if there's anything worse than outliving your health, it would be outliving your money.
Yeah.
And that's the thing that will happen to a lot of folks if they go into this myth that as we get close to retirement, we got to get more conservative because we can't handle a down market right before one retires. And this, to me, is the fallacy of the wrong time horizon.
Yep.
People think that retirement is like it's the goal line.
That's the end date.
It's the end date.
It's when it all stops.
It's right. It just we've retired. Hallelujah, and now. There's just this abrupt change, and at that point, whatever money we have is what we have, and that's how it works. That's not the case at all. Again, retirement is a stage of life. It's not a vacation. The real time horizon is one's life expectancy. We are going to be investing for the rest of one's life. And one needs to assume that life is going to be long. I mean, again, we are living longer and longer. So the average person, when they hit age 65, if that's when they're going to retire, has a life expectancy still of 20 plus years.
Yeah, most people don't realize that if you get to 65, then your life expectancy is already going to be higher than average.
Well, right, because we talk about life expectancy being whatever, and I'm
73,
whatever they say it is nowadays. But that includes, our friends that die tragically young, and I look back at just my own life. The first friend I lost, we lost before we graduated from high school.
Yeah.
And so, and his name was Jamie. Jamie's, calculated into that average,
yep,
just like everyone else. And so, yes, every year you live, your life expectancy gets kicked out because you made it through that one hurdle. And so, yes, when you retire, then the average life expectancy is going to be more than 20 years, which is an important date for us, and this, but this goes back to my college days as an economics student. Our professors, we used to run these Keynesian projections, and they would run to infinity, and when they defined infinity as 20 years. And the reason is when you're doing projections from a statistical standpoint, anything you project beyond 20 years is really garbage. And
you get the same things.
And you right.
Mathematically, actually, the numbers are awfully similar.
Yes, they are very similar. Yeah. Right. But yeah, what happens is you end up getting this spike, and which is not realistic, and right. It just one cannot rely on mathematical models that go beyond 20 years. So, in our investment policy statements for all of our clients, the longest time horizon we ever will put down in paper is 20 plus years, because that might as well be forever.
And the point of this us nerding out on this is because at retirement, you still have, this money has to last you for 20 plus years, which might as well be eternity. in the way that this works.
Right.
And so it's a constant. You are still investing. You still have to do all those things. It's not as if at this moment the entire world changes.
Right, but it also takes a lot of the pressure off, because now retirement isn't just this flip the switch. It's a transition into another stage of life. And your portfolio can transition just like one's personality does, or one's daily routine transitions. You don't have to just flip a switch, which means that if you are retiring in 2022 or 2023 and we're in the midst of a bear market, it doesn't mean that you're going to be living on less for the rest of your life just because you experienced a bear market right before one retired. And that's another myth that kind of comes from our industry, unfortunately, and what we have always felt is one of the biggest problems in our industry is that our industry has become a product pushing industry instead of a service industry. And they try to solve all of these problems by creating a product that will work for everyone, that is, you just kind of plug and play. And we need to save for whatever. Everything turns into a product, which is great for the industry.
Yeah, if you are on Wall Street,
Oh, yeah.
it's very nice for you.
No, it is. It is, because what happens is, if you go back before the days when everything was like that, you had a very clear separation in the financial service industry. And even when I started in my career, which granted was 30 years ago now, but doesn't seem like it was that long ago. So when I started, there was the sell side of the industry and there was the buy side of the industry. And the sell side is what everyone thinks of as the industry. That's your big Merrill Lynch, Smith Barney, Goldman Sachs, Morgan Stanley, all the big brokerage firms that are out there that that people think of as being Wall Street, in the financial, and it's the stockbrokers. And so all of those big firms, especially the big national ones, they're all investment banks out of New York, and their job as an investment bank is to raise capital for large corporations. And if Coca-Cola needed money to invest in whatever, they would go to one of these big investment banks. Let's just say Morgan Stanley, just for the sake of argument. They go to Morgan Stanley, and Morgan Stanley says, "Okay, we're going to issue some new shares of stock, or we're going to issue a bond, and we're going to raise money so that Coke can build a new factory or whatever Coke is doing." And then they have to sell that. They have to sell it to investors. And so back in those days, how do you sell this to people, in Wichita if you're in New York? Well, you had to have someone in Wichita.
Yeah.
You had to have an actual person. And so they would have a broker out there, and they would say, "Hey, we need to sell, X number of shares in Coca-Cola because we're raising money for Coca-Cola, or we need to sell this bond that we just created for Coca-Cola." And their broker in Wichita would get on the phone and call all his clients and say, "Hey, we're selling Coca-Cola today. You want any Coca-Cola?" And
Yeah.
people would say yes or no. And that's how the business worked for years. Well, that's all been taken away by technology. So technology has completely removed the need for there to actually be someone in Wichita, because people in Wichita can just simply log online
Yeah.
and do everything directly themselves. If they want to buy shares in Coca-Cola, they can do that. And so it is very, very simple. And so that really removed the purpose of the stockbroker. And so the stockbroker had to shift. And what they did is they kind of shifted to the other side of the business. So again, you go back in that time, that was the sell side of the business. The buy side of the business was investment advisors. And we often also talk about being money managers. And these were the people that would actually become a fiduciary to their clients and say, okay, we will make investment decisions on your behalf.
Not ask you.
And we're not asking you questions, but we're going to actually manage your money for you, and based on how one would agree. And there was a clear line that divided the advice business, the money management business, from the sales business. And those money managers would also buy stocks from those stockbrokers, because that's the only way
that's how you bought stock.
You could buy a stock.
That's how you got it.
That's how you had to do it.
Yeah.
And so technology kind of did away with the need for the stockbroker, and in most industries, like the guys that make buggies for horses, they just go away or they transition to something else. But in our industry, they just kind of changed their title, and they changed their title to financial advisor, because they weren't allowed to call themselves investment advisors, so they call themselves financial advisors. And they started suggesting that they were giving advice. What they're really doing is instead of selling individual stocks, they're selling products.
Yeah, they're selling these products. Yeah.
On the other side, the money managers didn't mind, because most money managers are they're technical people. They're not people. They want to stare at their spreadsheet and manage their portfolio and make those decisions. And it's just easy. I can live a life where I don't have to deal directly with clients. I can create a product with the strategy that I want to run, and these brokers will sell my product.
They can sell it for me. Yeah.
And so this works beautifully for the industry. It really works great for the industry, because the money managers get to just manage money, and that's all they do. And they have these products that the brokers then sell. The brokers don't have to go away. They can continue to sell something, and it works great. Unfortunately, the one entity it doesn't work for is the client.
Yeah, well, specifically, it's the worst in that moment, potentially, when you're transitioning from not retiring and, saving money, to the moment where
Right.
you actually need to retire and need to live off of your money.
Yeah.
That's where a real problem, and that's where this scare and problem and this idea of the endpoint really creates real issues and problems for people.
Yeah, absolutely. Because what happens is, and this has quite frankly been a panic issue for our industry, because they don't know how to deal with it. This arrangement that they've kind of created over the last 25 years or so, works great for the industry, and it does work for people who are in the accumulation phase, because you can overgeneralize everyone's goal when they're accumulating money for retirement as making money.
Yeah.
And every product at the end of the day is going to be about making money. And so while it's not tailored and it's not perfect, one can build a portfolio simply using these products that will make people money.
Yeah.
And one will be allowed to accumulate assets towards retirement. The problem then comes is what happens when you get into retirement. Because in retirement, everyone's situation is truly unique. Mm-hmm. And what the industry has done is, because it's how they've evolved and it's all they really know, is they keep trying to come up with a product. We have to come up with a product that is the retirement product. The problem with that is that then it does put undue importance on that transition
that moment
date.
All of a sudden becomes extremely important.
Because now you're going to take your money out of all of these products that are accumulating wealth for you, or money for you, and you're going to transition that to a product that's going to pay this out over your retirement. And if that is what one does, then yes, the date you do that becomes extraordinarily important, because however much money you put into that product
is the sole determinant.
Right.
It's the sole determinant of what you get for your entire...
Yeah, absolutely.
Yeah.
But that's not the way it needs to be.
Well, that's why it's so important to think of this as a service industry as opposed to a product industry.
Well, it is. It is absolutely a service. It should be a service industry, and the way we do it, it is a service. But that also requires more of a direct relationship with the money manager.
Yep.
Because now you're talking about actually building a portfolio for you, not taking a product that's off the shelf and saying, okay, this is what's going to work for you, or even a combination of products that are off the shelf. We're talking about you need to get back to getting to actual individual securities that are income producing and building a portfolio that, and our philosophy is very simple, is that we're going to build a portfolio that will produce the income that you need while taking as little risk as the market will allow at the moment. So that's how we do it. The philosophy is very simple. In practice, you have to know what you're doing, and it becomes a little bit more complicated.
Yeah, and I want to talk a little bit more about the details of that. But I do think that it's extremely important to understand why, if this is a service, and to explain that the flexibility that gives makes that date less important, right? Because again, if you have to transition and all of a sudden you have to buy this product, then that matters, right? But if this is a service, then you can say to a client, let's do this over time. If we happen to be in a bear market where this happens, we can make this move over time. We can hold your hand through this process. We could start generating income 2 to 3 years from now. And while we're waiting for this to happen, we could put money aside to pay you what we need to while this transitions. It just gives a level of flexibility to this whole process.
Right, and I think probably the best way of going through that is just kind of talk, at least in large scale, about our history of working with people in retirement and providing their income. And so, we have been doing this now for almost our entire 20-year history, and a lot has happened over that time span.
A lot of different environments.
A lot of different environments. But one of the things that's been universal until right now, is that we've lived in an historically low interest rate environment. And this is the other problem that the industry has, because when they create products for producing retirement income, it's always revolving around bonds and interest rates. And then remember, a bond is just a loan. So, the interest rate environment will determine how much one pays on a loan, and that's the same thing for corporations or a government when they borrow money and issue a bond. And when interest rates are very low, those bonds are paying very little interest. Mm-hmm. And so how does one actually retire in that environment? And if you're selling a product, that's a big problem. For us, it was not a problem because we're not selling a product. We're managing a portfolio and doing a service. And the answer was really very simple. You have to look at dividend-paying stocks. You have to look at preferred stocks. You have to look at higher yielding bonds. And you have to build a diversified portfolio that will pay out the income that you need. And a lot of people, again, because of this myth, you got to reduce the amount of stocks you own and increase fixed income or bonds as you get close to retirement or in retirement. That's just like this mindset that people have. And so they get really concerned about, well, you have more stock even though you're retired.
They're stock in their stock.
But exactly. You looked at two examples, and these are examples of stocks that we actually own for clients in portfolios where they're appropriate. But like Duolingo. All right, Duolingo is a language learning application. It is brand new. My 12-year-old daughter loves it. She's learning how to speak French. And she thinks it's the greatest thing since sliced bread. It is a company that doesn't have earnings yet.
Very
It's
young
very
company.
young company. Its stock is appreciated dramatically year to date.
But it could also go down.
But it can also go down
in a short term.
year to date. And then you contrast that with Southern Company.
Yeah.
which another stock
A utility.
that we own, but this is the largest utility in the southeastern United
Boring.
States. It's right.
It pays a very low. It pays. I mean, it pays a yield. It has a high dividend yield compared to the market out there. And when the market goes down, it tends to go down a lot less.
Yeah.
When the market goes up, it tends to go up less.
No, exactly.
It's
and
more
that's
stable.
And that's the thing is that just when we just use these overgeneralizations, which happens when you're just selling products, is that a stock is not necessarily a stock, and one stock may be very risky, another stock may be as boring and safe as a bond.
Yeah, safer than many bonds.
Safer than many bonds,
Yeah.
At least over the last 20 years or so.
Yeah.
And so. So that's the thing that we do when people retire, is that we're building a portfolio that will actually produce their income. And so we've done that, and for most of the time, like in the financial crisis, for example. In the financial crisis, our income-producing portfolios performed extremely well,
much better than
relative to the market. Because these are the safest, yes, they're stocks, but they're the safest companies out there. They're paying a dividend. They are not in any financial distress whatsoever. Yeah. And so it weathered that storm extraordinarily well.
Same last year in 2022.
Same thing happened in 2022. You're absolutely right. Our income portfolio did extraordinarily well. That was not the case, however, in COVID.
For the COVID situation.
Right, because these again are going to be very safe, stable companies, and people are investing in these companies not because they're going to grow, but because of the dividend. And no one ever foresaw an environment where the government's just going to shut everything down.
Yeah.
And so all of a sudden, these dividends that appear to be extremely safe,
the one time maybe they weren't,
may not exist because the government's literally shutting everything down. And so that was a period of distress for our strategy. And we had to very quickly shift gears.
But we have the flexibility. Again,
Right.
This is a service, not a product.
Right.
We have the flexibility to do what we need to do there. And
Right.
so we made significant changes.
Absolutely. We made significant changes. And we also recognized, because that was a bear market, and in all bear markets, as painful as they are to go through, that is really where the best investment opportunities arise. This is when you get opportunities. And even when you're in retirement, you can still invest and take advantage of those opportunities. So what we did is that we traded out utilities and phone companies and things like that for things like Apple
and Home Depot
and
other high-level financial companies that are
right.
unbelievably high quality, that you could get yields that you couldn't have gotten for generations.
Right, and they do pay dividends, but it's a much smaller dividend than we normally are excited about. But these are extraordinarily high-quality companies, and they were the first ones to bounce back.
Yeah.
And that's how one recovers.
And once we got our portfolio levels and those back to where they needed to be, then we shifted again and said, okay, now let's move back into those safe dividend-paying names, so we can again be where we want to be there.
Right, because again, it's a service, and it's an ongoing service, and we're monitoring it constantly. And it's going to shift. And now that interest rates are going up, we've added more bonds to those.
Bonds have become a larger portion of those portfolios.
Because bonds are more attractive once again. So, that is what one can do when you're actually approaching this business the way that we think is the right way, which is that it's supposed to be a professional service.
Yeah.
It's supposed to be a direct relationship with the people who are managing your money, and to have the ability to navigate through the various stages of life, as well as the various stages of what's going on in the financial markets and what we're allowed to do.
Yeah, and I think this is the time we've got to talk about a cautionary tale and a public service announcement. When you create a portfolio like we do, and it's paying those dividends or income, those are fully liquid, and you can use that if you need it. So if you have an emergency or something comes up, that money is there for you.
Right.
What ends up happening in these, what are frankly scary times for many people when you're in a bear market, is the sales of annuities go through the roof because people are scared, so they buy these guaranteed products. And you see it out there. If you look it up, you'd see that more annuities got sold last year than had since the great financial crisis. And that's what happens every time. And these are they're frankly products of mass destruction in a lot of ways. But why don't you talk about that for a second? The problems with annuities, the issues that happen, and why you have to really be careful and steer clear of them, especially when you get scared like this and you see them out there, and why it's so important to discuss.
Right. Well, I think the first thing to say about that, and I want to be very clear, because we live in this day and age of people having extraordinarily strong opinions about things that they don't bother to actually learn anything about. And so just briefly in my background, and one of my previous lives, I actually worked for the Life Office Management Association, which is an educational association within the insurance industry, life insurance industry, and I was in charge of their annuity and retirement products and services. So I was the content editor. I was partnered with people who actually knew how to write,
writers,
and but knew nothing about annuities.
Mm-hmm.
And we worked together as a team to actually write the annuity textbook.
You're an expert.
So I know a little bit about annuities, and my current opinion on annuities has not always been my opinion, because I was like a lot of people who kind of approached annuities from an academic standpoint. They work great in theory. The problem is we don't live in theory. We live in the real world. And in the real world, annuities are egregiously priced. They come with clauses that verge on criminal. Mm-hmm. I mean, and we've seen this in real life events.
A lot.
I mean, and I'm not going to pick on any one particular company, but I remember for one of our institutional clients years ago, their vendor was an insurance company, and they were trying to add an annuity feature into the retirement plan. And we were asked to, read, to research it, and we, read the contract.
Which, by the way, is as thick as the Bible.
Right, which no one does. I mean, including the guys who sell it.
Yeah.
Nobody, and I just had, last week, I had two people from an insurance company in here, and I just asked them straightforward, as like, have you ever read your contract on your own annuity? And both of them kind of sheepishly looked at me and, well, of course not.
Why would I do that?
Have you ever tried to read one of these things?
Yeah.
But if you do read it, what you're going to find out is that there was all these promises made, and so this annuity, like a lot of modern annuities, you could invest in a mutual funds that are inside the product. They're really insurance separate accounts, but
like a mutual fund.
They're like a mutual fund inside the insurance wrapper. And then they would have guarantees. So they would guarantee that if you hit a certain high water mark, that you would never have a value that goes below that high water mark, no matter what happens in the market. It sounds so wonderful. And but here's the thing: when you read the contract, what you found out is that if you ever take the money out of the annuity, all those guarantees are gone. You've paid for them for years. You've paid egregious sums for them.
Fees, yeah.
And they disappear as soon as you take your money out. And when you do take your money out, you just get what the actual market experience, which is going to be markedly worse than it would have been, because you're now paying
3 to 4% a fee, most likely.
Right,
yearly.
most likely a 3 to 4%
on a product you should have
fee.
paid 1% on, maybe less.
Well,
you're paying 3 to 4%.
Actually, and we had this conversation years ago with a hedge fund manager. And he calculated that it was 7 basis points.
Well, I meant just the fees of the underlying funds.
Oh, well, right. But the actual insurance cost, so the value of an annuity, if you actually were to recreate it yourself in the options futures market, would be about 7 basis points. At least that was his estimate. And 7 basis points is 0.07%, or you think about like if a percent's $1, that's 7 cents. And so you have something that's worth 7 cents, and they're selling it for $4. Something's wrong.
Yeah.
And this is it is one of the most egregious issues in our industry. We really rarely ever say the word never, but one should never buy an annuity.
Yeah, I mean, at the end of the day, what happens is the only thing you ever get is the guarantee. That's the only thing you would ever get, 3 or 4%.
Right.
When you look in a history of these things and actually look in people's experience, you can get a 3 or 4% return on these things, and you lose absolute all ability to use your principal. So you cannot use that principal in most circumstances.
Right.
So it's just not. It's a very poor product.
It is, and we also know just from real world experience, because we've seen countless clients come in here that will have an annuity that they purchased 5-10 years ago.
No one is happy with it.
Every single one of them. The phrase we hear all the time is the biggest mistake I ever made.
I put all this money in there. There were all these promises made, and now none of those came true.
Yeah.
So.
And that is what it is.
Yeah. Well, I think that's it.
Yeah. All right.
Thanks you for listening to our first podcast, and we'll be doing it more often.
Sounds good.
Bye-bye.
Iron Capital Advisors is an independent registered investment advisory firm headquartered in Atlanta with clients nationwide. Learn more about us at ironcapitaladvisors.com. The Iron Capital podcast is produced by Iron Capital Advisors. Our awesome original theme music was written and performed by Michael Smith and Leah Calvert. This content is for educational purposes only and should not be relied upon for investment decisions or advice. Clients and employees of Iron Capital may maintain positions in the securities discussed. Please like and subscribe to the Iron Capital podcast on YouTube and wherever you listen to podcasts. Thanks for joining us. We'll be back with another episode